I've been with the Ukrainian Credit Union as an investment advisor since 2011. Credential Qtrade Securities Inc. is the brokerage which serves credit unions across Canada. The reason there is that kind of a structure is that in order for credit unions to provide the maximum ability to invest in investable securities, the way they're regulated, they need to have their own brokerage. You can open up any type of an investment account with the Ukrainian Credit Union Limited. The problem is the kind of securities you can actually hold in that account. And so in order to broaden the universe of investable securities for the members of the credit union, UCU, along with all other credit unions across Canada, have partnered with Credential Qtrade Securities Inc. As their brokerage. Actually, Credential was founded by credit unions. And what this does is allows our credit union members to open an investment account through Credential Qtrade Securities Inc. and then be able to invest not just in GICs or Canada Savings Bonds or Ontario Savings Bonds, which is what's you're limited to in an investment account through the credit union, but now you can invest in mutual funds, stocks, bonds, exchange traded funds, and the whole gamut. And so it offers a broader opportunity for the members of the credit union to grow their wealth. So why would you not want to invest in marketable securities? And there's always been plenty of reasons. We know that our membership is a conservative group of individuals who tend to focus mostly on GICs and real estate. And real estate is expensive now, and it keeps getting more and more expensive in Toronto and southwestern Ontario. And GIC rates have, for the last few years, been very, very low. And so it has kind of created a frustrating situation as individuals want to see a better return on their investment. There are many reasons why people have been afraid to invest in the markets. And here we're talking about the stock market, whether in Toronto or in the United States, in New York. And we can start with basically looking at the last 30, 40 years. In 1987, Black Monday, the market dropped by 26% in one day. In the early 90s, you had the Persian Gulf War, and as that war broke out and economies went into recessions, markets dropped by 22%. In 97, 98, again, we had the Asian tiger and Russian debt default crisis, which again caused the markets to drop by 28%. 2000 to 2003, what's commonly known as the dot bomb, we had the tech bubble and the internet companies basically after a huge run up between mid 1990s, so 95 to 99, 2000, you had a tremendous run up as new companies were being created, all linked to the internet, and anything that had a .com at the end of it became a darling, and people were investing their money in it and made a lot of money on that run up. But at the same time, when reality kicked in, people realized that a lot of these companies were basically just a name with a .com at the end of it. As it all straightened itself out, it caused a 45% drop. 2007 and 8, again, we saw a big market correction following a big strong run up. And a lot of that was because of the asset-backed securities. Banks were basically lending money to anybody who wanted to buy any kind of real estate. They were not, especially in the United States, they were not asking for proof of income. They were not, they were basically giving them interest-only loans to purchase the real estate and then packaging those mortgages and selling them into the market. And banks thought that this was a way that they were actually reducing risk on their books. At the end of the day, when the chickens came home to roost, the Federal Reserve and the government of the United States said, no, you can't do that. Those stay on your balance sheet. And all of a sudden, banks stopped lending to each other, and there looked like there could be an actual financial system crisis globally, especially in capitalist countries. And so we had a big pullback in the market. Recovered since then. 2011 and 12, we had what was commonly referred to as the pigs. Portugal, Italy, Ireland, Greece, and Spain were close to defaulting on their government debt. That caused a big crisis, especially in Europe, but it caused markets to drop by almost 20%. 2015, 2018, again, markets pulled back, and now we have the current COVID crisis where economies globally have shut down, which caused stock markets to really take a plunge. Now, in general, businesses and economies go in cycles, and you have a rising economic growth, you have rising stock market values, and everybody starts to feel great and they want to invest more as things go up. For the most part, people are momentum investors. And so when things are going very well and very strong, they want to put more and more money to work. When things start to pull back, they look at it, they assess the situation, they know that things tend to go higher over time, and so they stay invested. But when things start to really hurt, when markets drop and asset values drop by 20% or 30%, all of a sudden things start to really hurt and human psychology kicks in. And individuals get very concerned and they say, oh, I'm losing money, I've lost my money, what am I going to do? Get me out, get me out. And what happens is a lot of people invest the most near the top of a business cycle and then panic the most at the bottom of a business cycle, forgetting that things go in cycles and things don't always stay bad, things don't always stay great. So we saw the multiple reasons for why people won't want to invest. And here's what the net effect has been of all those events over time. So in this chart, you can actually see all 8 panic events or events that would cause you not to invest, where they actually occurred and what the stock market looks like through those periods. So on this chart, you can see the red line, which represents the S&P TSX Composite Index total return. And the blue line that kind of mirrors it is a balanced portfolio of 60% equities, 40% fixed income. And you can see that over time, yes, those crises occurred. There were drops in market values, but over time, the trend in values go from the bottom left to the upper right. The orange line just below those is the 5-year GIC rate, and below that, the green line or lime green is the Canadian inflation rate. So you can see that over time, if you truly want to make a large gain over inflation and get your money to work the most efficiently and effectively, you've got to be invested in the markets, irrespective of the crazy events that occur. Now, obviously, time works in your favor. And so individuals at different periods in their own life cycle may be looking at this in a different way. However, time works to your favor with respect to asset value. So the longer you're in the market, the better performance you're going to have. And one of the major things that all of us, professional investors, hedge fund managers, mom and pop investors, retail investors, everybody has to work against is human psychology. When things are great, we want to participate in that greatness, so we're ready to put more money to it. When things look bad and bleak, we just want to pull everything out. And what really we need to be doing is actually putting more money to work at those points in time. Now, just kind of as a follow-up to that, nothing moves in a straight line, but the direction is definitely clear, the bottom left to the upper right. And you can see these periods that generally upward trends tend to be long and rise at a slower pace, whereas downward trends tend to be short and very sharp. So one of the analogies that I've heard people use is that markets rise like an escalator and they drop like an elevator. And so we can definitely see this February to basically the end of March, middle of February to the end of March, 6-week period, we had a dramatic and aggressive drop in market values. If you look at the Dow Jones Industrial Average as a indicator of market values, or the S&P 500 index, you see that markets dropped by 35% plus. very quickly over a 6-week period. Since that time, we're to the end of May, so you've got middle of March, you got all of April and all of May, we've seen at least a 50% recovery in those values, and today looks like another strong day on the markets. Will we fully recover to where we were peak valuations end of January, beginning of February of this year? Will that happen before the end of this year? It may not, we don't know. The issue is that it's easy to see things that have happened in the past. It's extremely difficult to see where things will be going into the future. But what goes up does come down, but what does go down absolutely does go up. And one of the major reasons for that is basically the pressure of money. Every year, year after year, more and more people join the workforce, more and more people generate an income, more and more people are purchasing houses, more and more people are purchasing cars, consuming gasoline, more and more people are saving through work, putting into a pension fund, putting into their RRSPs, opening TFSAs. Year after year, more and more money is going to work. More young people form families. They go and they buy insurance. They buy life insurance, they buy critical illness insurance, disability insurance to protect their number one asset, which is themselves. They generate an income that helps feed and fund their personal needs, the needs of their household, needs for their children, their spouses. And so in order to be able to do that, they set aside money for their children's education through an RESP fund, or for their own pension in the future through an RRSP fund. And so money is being put aside, and that money has to go to work. Buying an insurance policy, individuals pay premiums on that insurance policy. The insurance company collects that money and they've got to put it to work, goes into the market. So the pressure of money will continuously drive up asset values. That's one of the reasons why real estate, even though they do have pullbacks, individuals who bought at the end of the 1980s, beginning of the 90s, saw a pretty dramatic drop in their real estate value of the homes they purchased or other properties they purchased that took pretty close to a decade to recover. But after that, it's been a pretty dramatic run up since then. Same thing is with equities. It's just the pressure of money continues. Canada is a country that accepts immigrants. People immigrate with money to this country. They put it to work. They buy real estate. They eventually end up getting jobs. When they start working here, they set money aside for their retirement. Again, that money's got to get invested in order to generate a return, and that's what happens. The pressure of money is a tremendous force that helps drive asset values in Canada, in the United States, and globally. So you can see from the earlier charts, what goes up does come down, nothing goes in a straight line. However, so it becomes extremely difficult to time the top and time the bottom. When things are really good and we're at the top, people feel great about themselves. They feel no reason to get out of the market. When things are low and the markets are down and the press is harping about how terrible things look, it works against our, it feeds on our human psychology, and we become more anxious and more nervous and more concerned, and we feel like we got to pull our money out when actually what we should be doing is putting more in. This graph kind of demonstrates what happens if you miss some of the best trading days. So if you were fully invested and stayed invested from January 1986 through to December 2019, a $10,000 investment would grow to $142,000. If you missed the 10 best trading days within that period, your investment would only grow 6-fold instead of 14-fold. If you missed the best 15 days, it would only grow 4.5-fold as opposed to 14-fold. So what this graph clearly demonstrates is that it's not about timing the market, getting out at the top, getting in at the bottom. It's time in the market, because it's extremely difficult if you're going to try and play the game of getting in and out all the time. I'm going to catch the peak, I'm going to get back in at the bottom. If you miss even a few of those best trading days, you can end up missing some really great returns. time in the market is probably the most important thing. The issue is how old are you? At what stage in your life cycle are you? And then all of a sudden, timing, without question, does become an issue. And sometimes it is good to get out, wait and see where things are, and then look for great opportunities to buy in when something's become pretty cheap. So these are things to kind of keep in mind to kind of help you navigate how you're going to run your investment strategy. So one of the things that the 2007-2008 financial crisis taught, it's being repeated again now, is that central banks across the globe, led by the Federal Reserve in the United States, they provide liquidity to support economies that are heading into recession because of a variety of reasons. So we had a financial system crisis in 2000 and 2008. Through this COVID crisis, we basically had a shutdown of economies globally. That creates a crisis. Back in the late 20s and early 30s, when there was a crisis, it happened at a time when the central bank strategy was to keep raising interest rates and pulling liquidity out of the system. What that led to was a Great Depression. And so in order to avoid that, what governments do today is they actually inject a lot of liquidity into the market. And so into the economies, into the market, wherever it goes, they don't really follow it, but what they want to do is make sure that the economies have ample liquidity and monetary assets in order to be able to keep things running and be able to support people who do end up either losing a job, to make sure that asset values stay stable. And so here what this chart shows is all the quantitative easing events that had occurred following 2008, and then again what's been going on recently as the Federal Reserve and other central banks lower interest rates and also provide massive injections of capital into the economic system. And you can see the blue line shows how the S&P 500 index reacts. So the Fed can grow its balance sheet where they basically say, we will take assets from the financial system in exchange for liquidity, and we don't care what those assets are. Usually they only wanted the highest quality, but when we come into a crisis, they're willing to take almost any kind of asset. So to kind of make this noisy graph a little clearer, here you can see where the QE1, QE2 occurred, QE3. Then when the economy kind of found its footing, the Federal Reserve starts to lower its total assets on its balance sheet. And then when crisis hit again, it spikes back up again because they're ready to provide the liquidity and take on the assets that they need in order to support the financial system. So again, you can see what happens where, and this is basically showing how the federal funds rate, which is the interest rate that the Federal Reserve sets, and from that, it's the benchmark that all financial institutions, mostly banks, use to set their interest rates. When things are going and growing great, in order not to let inflation get out of hand, the Federal Reserve raises interest rates to kind of keep the balance between growth in the economy and the amount of liquidity that's in the economy. When things start to tighten up and economies start to shrink and contract, the Federal Reserve quickly drops rates. So you can see what happened in the last crisis. The Federal Reserve dropped for the first time interest rates pretty close to zero, and you can see that from the 2007-2008 period down to 2010. The interest rates dropped dramatically. Started ratcheting it up again from 2016 to about 2019. And then again, as this new crisis has hit, the Federal Reserve dropped interest rates to zero very, very quickly. So the Fed is there to support asset values because they know that the economy is dependent on asset values being stable and growing over time. More and more people, more and more money, you need to have asset values growing. So with all this liquidity injection and interest rates going to zero, what the Fed actually wants to see, and most central banks want to see, is a return of inflation. They need inflation because inflation helps when banks and corporations and federal, provincial, municipal governments globally raise debt in order to fund their economies. That can become burdensome. With inflation, the value of that, the present value of that debt outstanding tends to get smaller. And right now, with really, really low interest rates and a ton of liquidity in the economy, there is the potential to have a big run up in inflation. Now, what this graph here shows you is what the erosion of your purchasing power of the dollar is based on 2% inflation, which are the green bars, 4% inflation, which are the red bars, and then 6% inflation, which are the blue bars. And you can see that over time, as inflation rises, the purchasing power of your dollar really drops over time. Now, with really low interest rates and really low coupon rates on government debt, provincial debt, corporate debt, any big spike in inflation will really erode the value of those fixed income instruments. GIC rates now for 1 year are sub 2%, which is below what the government and the central banks are trying to reach for inflation. So if it's below inflation rate, you're actually losing money on the investment. And so it makes equities more attractive, because at least there you've got a fighting chance that you can get a return that's better than the inflation rate. And so the landscape currently seems pretty clear. We've got a lot of liquidity being injected into the economy. Governments are supporting people who have been temporarily, and we don't know how many will actually be permanently out of their jobs that they had prior to the shutdown of the economy. We know interest rates have been dropped. Governments are providing interest-free loans to small businesses. They're providing wage support and unemployment insurance support. What they want is individuals to have the liquidity to be able to go out and spend again, to cover their costs, and to hopefully get these businesses up and running again and re-employ all those individuals. All that liquidity has a strong potential to kick inflation higher. If it does, commodity prices are going to be one of the first ones to benefit from that. And we've already seen some of that, as the price of gold prior to COVID was already starting to move. It went from about $1,200 an ounce to about $1,700 an ounce. It bounces around. Gold is one of the first indicators that there's a potential to be an inflationary spike, but all commodities, all hard assets, real estate, oil, gas, all sorts of base metals, they will begin to increase in value as interest rates go down. Now, right now, looking at where things stand in the market, we've had a pretty strong bounce back, but we're still not fully recovered through the levels where we were. So now's a really good opportunity to look at things that haven't regained as much as they lost from their February peaks, and look for opportunities to invest. And with that, I'll wrap up my official presentation and open it up for questions. And if I can figure out, I will stop sharing so that Yuri can take over. Thank you.
Okay, thank you very much, Michael. Can you hear me, Michael?
Yep.
Oh, perfect. Okay, so that was very informative. I always enjoy listening to you speak about the market. You clearly spend a lot of time paying attention to what's going on, so the rest of us can not have to expend as many brain cells on this. There are a few questions here. The first one, I believe it was asked when you were talking about immigrants adding money and obviously joining the workforce and thus improving the economy. So the question was, does the inverse apply though nowadays, with millions of people withdrawing from the workforce quite often involuntarily? Has that already been, I guess, priced into the market, or?
Well, I think the government, so I can just give an example from my own family. I have two individuals in my immediate family, a brother and my wife, who are medical professionals. And so they work in small medical offices that see patients. My brother's an optometrist, my wife is a dentist. Their offices were forced to be closed. And so they were without income for the last 2-3 months. Now the government's providing a special income supplement of $2,000 for 4-week periods, and they can apply for that in order to help them pay for their monthly expenses. And so that liquidity, I know the HST refund has been increased as well, and childcare benefits have been increased just automatically by the government. So they kind of understand that people need cash. Being without work has hurt a lot of individuals, especially those who work part-time or have a couple part-time jobs in order to make ends meet. And so they've just automatically started giving individuals extra cash to kind of hold them over. And I believe that the program, I forget the name of it officially, the CERB is the acronym, I believe, that my wife and my brother can collect, and it's for 16 weeks. So it's 4-week periods where they can get $2,000 a month. And so that kind of money can actually go and help support paying for rent or food or other purchases that may need to be made. But if you don't need that, then that money can actually go and be invested.
Okay, thank you. And you mentioned at one point in your talk that there were a few sectors that are still underpriced. What would you, which ones are generally would fall into that category?
So I kind of did a quick scan of where valuations stand on a sector basis. And I looked at the 10 sectors of the S&P TSX composite index. And right now, financials, which is 30% of the TSX, is actually trading at the lowest PE relative to all the other sectors. And the other sectors would be energy, materials, industrials, info technology, telecoms, utilities, consumer staples, consumer discretionary, real estate, and healthcare. And the PE on Canadian financials, which would include banks, insurance companies, REITs, is trading at under 12 times 12-month earnings. And so historically, people look at a stable PE ratio of, say, or an average PE ratio of 15 times as being considered as good value. Anything below that means it's really value, and anything above that may be looked upon as slightly expensive. And it depends. It depends on the growth of those earnings. But for the financials to be trading at the lowest PE ratio of all the sectors, that rarely happens, and that's where I see probably some of the best opportunities.
So I'll jump in here with the pitch that I always make to people. Keep your money at a credit union, but invest and own a bank so that you can get the best of both worlds. Here's a relatively simple question, and then there's going to be a more complex one after that. Do you open investment accounts for non-residents?
Non-residents, that's it's a little complicated. I'll put it that way. Generally, no. The individual needs to be a resident in Ontario or wherever we're licensed. I'm licensed in Ontario and BC. I know my colleagues, Roman Mlenko and Katerina Litvinuk and Tatiana Korolyova may be licensed, Vlad Karman. They may be licensed in other provinces, but we're all licensed in Ontario. So I believe you need to be a resident of Ontario in order to open up an investment account through Credential Qtrade Securities.
Okay. Now, here's a question. This is a bit of a longer one, so I'm going to read it out. Your chart showed us that for most investors, it is much better to stay in the market than to try to time the market, and B, invest when the market is down. But you also said in some situations, depending on one's life stage, it may be a good idea to get out of the market and watch what happens before deciding to come in. Can you give us an example of a situation when you advised a client that it was a good idea to cash out of the market and wait and see before deciding to go back in?
So yeah, so when the markets started to decline and I had individuals who were income dependent, and it looked like stocks. So one thing is stocks could end up cutting their dividends. Mutual funds may lower their distributions, things like this. So what you want to do, if they're income dependent, you may want to pull out so that you don't suffer the double whammy of a drop in income as well as a drop in valuation. Sit in cash for a bit and then look for opportunities, because there will be situations where certain stocks get beaten up more than others. And then you can watch and see, do they cut their dividend? Do they not? If they maintain it, you can buy them pretty cheap, and then you get a much bigger yield going forward. So there are situations like that.
Okay, and next question. Why do you think oil stocks are so strong now, given the recent negative pricing of oil?
So oil stocks are very strong because this has been one of the most rapid drops in oil prices and then rebound back that we've ever seen. So in their 150, 160-year history, oil prices were never negative, but they actually were negative. I believe it was at the beginning of April or beginning of May where prices went negative $35 a barrel. And I think there was a big story out there that Carl Icahn was building what's the word I'm looking for? Containers in order to fill them up with oil and get paid to do that. And then all of a sudden he was going to make billions of dollars on the rebound. Negative prices for assets are very unstable and very extraordinary, and they don't sit there for very long. The reason prices went negative is there was a fear that oil that's being produced had nowhere to go. Demand had dropped. Warehousing and storage facilities for oil were starting to reach their maximum level, and the more oil that got produced had nowhere to go. And so the producers would actually pay you to take it off their hands. And I think that's one of the reasons, but it's an anomaly because oil is probably one of the most heavily traded commodities that are out there. And so you have the influence of traders as well as producers and consumers of oil, including refineries that purchase oil from producers in order to refine it to other products such as gasoline. So you got a lot of different players and stakeholders involved in it. It's very liquid. It trades a lot continuously. And so that can create some complications. So we had a very rapid drop in the price of oil. A lot of people have read the fight between Saudi Arabia and Russia, where the Saudi Arabia is trying to take the lead to balance supply with the demand. It's very difficult to know how much demand has actually dropped, but when economies get closed, travel stops, airlines are not flying, people are not driving to work, there's going to be a drop in demand for finished products like gasoline. And so refineries don't have anywhere to send their finished product to. They're going to buy less oil. And then the producers want to keep producing because they don't want to shut a well and then restart it again. Those costs are also greater than if you just keep the reserve running or the oil drills running. And so there's a lot of complicated little factors, and the market reacts very quickly until people kind of get their head around actually what's going on and they get some more detailed information about where things are really going, and then things bounce back up again. So oil had dropped from, I believe it was around $57 a barrel to negative to, I think it's around $38 to $40 right now again. So that was a pretty quick V-shaped snapback. And so oil stocks that got completely punished are now the darlings again, and everybody's piling into them.
Is there, still room for the oil stocks to continue growing, or, the people who didn't invest a couple of weeks ago in them are kind of out of luck at this point?
I think there are still some that haven't caught up and haven't bounced back as much. Some have bounced back a lot more, others less. So I think you have to become a little more, what's the word I'm looking for? You have to be a little more discreet and a little bit more focused on finding the ones that haven't bounced back as much and understanding their situation. Because a lot of these oil companies, they carry debt on their balance sheet. You don't want a financial crisis to follow this economic crisis, because then some of these companies that carry a lot of debt may have trouble rolling them over. So there's a lot of little factors that you want to look at before you make your decision, but there are some oil stocks that haven't caught up yet that will be caught up, because people will rotate out of the ones that have run up already into the ones that haven't yet, and they'll help drive those values up as well.
And then a question about the retail sector, because some parts of the retail sector have been hit very hard, but there's others that have been open, like groceries and things like that. So are there, what are the things that you should be looking at in the retail sector?
I think what you want to do is you want to look at retail sector where the companies are large, strong, have a good base. So for instance, Loblaws, Shoppers, those look very good. You want to look at, say, corner stores, Alimentation Qtrade or Jean Coutu are very interesting stocks in that space. You want to be careful of the Reitmans and maybe some of the higher end, more niche focused retailers. Canadian Tire got beaten up severely and has bounced back sharply in the last week or two, and it's probably the best general retailer in Canada. So you want to look at something like that potentially.
Yeah, it's interesting. I read a couple of days ago that Walmart has gotten out of the auto service business, so that's going to be a plus for Canadian Tire.
Yeah, so you have to be careful because these things move so quickly. And I also think that, you know, the market environment has changed. You do have a lot of institutional money managers who use sophisticated quantitative models and algorithmic trading models that have also changed a little bit the nature and the speed with which stocks can drop and rise back up again. So you always want to be focused on quality stocks. Even if they get beaten up, they do bounce back, because a quality company is a quality company. And you know, you just want to keep your eye on those and look for opportunities there.
Okay, and the next question that I don't know if you were able to, this may be a bit complex to answer fully, but what is your fees for opening or keeping an investment account? I guess that probably would vary.
Yeah, it depends on a few things. There are administrative fees for registered accounts, such as tax-free savings accounts and RRSP accounts. For non-registered accounts, there are no administrative fees. But then, depending on the size of your account, it might make sense to be in a fee-based account or not in a fee-based account. And I think Roman Mlinko is giving a presentation later on the different types of accounts, and I think he'll be able to provide a lot more details on that.
I believe that's June 18th is his presentation. If I'm not mistaken, let me just double check to make sure I'm not giving you the wrong information, but yes, June 18th he will be presenting on that. Okay, lost my space. How much should we fear inflation at the moment?
You know, that's a very, very interesting, important, yet tricky question, because I was just reading an article out of the Wall Street Journal that some of the hedge funds are betting that there's going to be a big spike in inflation, and yet they expected that after the 2007-2008 crisis with that liquidity injection, and yet inflation didn't come roaring back. This time, the hedge funds are making the bet that the inflation will roar back, and one of the arguments is that the liquidity injection this time is much larger than it was back in 07-08. I don't know, it's very difficult. Time will tell. The price of gold has kind of reflected expectations that inflation could spike up. But again, as the values of stocks and market indices go up, people tend to rotate out of gold and into the markets because they want to get the faster, higher return immediately. And so gold prices have kind of stopped their rise, but that doesn't mean they won't start running up again. So it's a very good question. I think it's a question that's being studied by a lot of people, and yet nobody really has a very good handle on what to expect with respect to inflation. But everybody does believe that central banks do want to see some inflation because it's easier to control inflation than it is deflation. Deflation does much greater damage to economies than inflation does. Inflation can be fairly easily handled through interest rates. Deflation becomes really problematic, especially when interest rates are so low right now.
And that would the inflation necessarily have a negative effect on share prices, or conversely, would it keep on driving them up?
Well, as long as corporations have pricing power, you get strong inflation. Generally, strong inflation is going to be driven by consumer spending. In the United States, I believe it's like 2/3 of the GDP is driven by consumer spending. And so if consumers are really, really spending and they're driving prices up, it means they've got more disposable income to spend, and it probably would translate into corporations able to raise prices, increase their profitability. And so if that happens, revenues grow and profitability grows, then values for those company stocks will grow. Where the problem will be is in fixed income, because interest rates are currently very low. And so if inflation starts to run away, existing bonds will get clobbered.
And so we have a follow-up question to that. Can the shortage of products create a hyperinflation?
A shortage of products. Yeah, absolutely. If the demand really starts to run up. I mean, this is the whole battle that's going on in the oil sector right now, is to rebalance supply with respect to the expected drop in demand. But if demand really runs up and the supply is getting cut, all of a sudden prices for oil, prices for gasoline are going to shoot up again. If people go back to work, all of a sudden their pent up demand, they haven't been able to go to shopping centers, they haven't been able to spend or drive their vehicle around like they did when they were working. That kind of demand shoots up very quickly. If the supply isn't there, obviously the prices are going to go up. And I think people who are doing home renovations, we're doing some right now. When you look at how fast prices are changing there, things are moving quickly. Look at the masks situation. You could buy a facial mask to protect yourself from viruses and things for basically $1. And now they're being doubled or tripled in price now, and there's your inflation. So I think it's still early days to get a sense on where inflation is going to go, but definitely when the demand for certain products jumps and the supply doesn't catch up, prices will go up.
The hyperinflation topic's popular. The next question is, could we get something like the hyperinflation that the Russian Federation experienced in the 90s?
No, it's really difficult to believe that would happen. Our economies are much more balanced, much more sophisticated, and much more mature. You have to remember that what happened in Russia and the former Soviet Union is you had basically decades and decades of pent-up demand with no supply of product. And so the moment those economies broke away from a command structure to a supply-demand structure like any other capitalist country, you had this monster demand that came out of nowhere, pent up for so many decades, generations even, all of a sudden wanting to buy anything and everything they could because it hadn't been available for so long. You get this massive hyperinflation. I don't think we're going to see that here.
So a question that's on everyone's mind, do you think the market has priced in a potential COVID rebound into these price rebounds that have happened, or would a second wave of COVID infections cause things to go bad again?
That's a really good question, because that's very difficult to answer with any kind of accuracy. You got to remember, never before have so many countries around the globe closed their economies. You generally don't do that at all. And I don't know how they correlate the fact that we've closed our economies and how many people became infected or got seriously sick or passed away because of COVID, and which demographic groups were affected the most. If there's a second wave of COVID, are governments ready to shut down the economies again? I don't know. It's a very good and difficult question to, to contemplate, but I don't think anybody really has the right answer. Different economies closed at different rates in different capacities, and I think now what's going to happen is people are going to look at those, look at the Swedens, look at the Taiwans, look at the South Koreas, and then look at the United States and the UKs and say, okay, which ones were most aggressive in closing down? What was their impact? Was it worth doing that or not? Like, the cost benefit analysis now needs to be done with respect to the effectiveness. And even if that is being done, it doesn't necessarily mean they're going to come up to the right conclusion with what happened and whether it was effective to close everything down. How much more debt, because when you close the economy down, people still have to eat, people still have to spend, you have to make their rent payments, their mortgage payments, and all of that. Like, how much can you suspend all of that? I don't know. I don't think anybody really truly knows. And how much capacity do governments have to go out and borrow so that they can just hand money back out to people? I mean, when people are not working, you're not collecting taxes from them because they're not generating an income, and there's no payroll tax being paid, and there's no income tax being generated because there's no income being generated. So it's a really difficult and tricky question. I think governments, when they do the final accounting of everything, may not want to be closing economies down so aggressively again. You've got to come up with better solutions so that people can be protected and stay safe, but at the same time remain productive.
That seems quite logical. Anyway, we're really at the end of our time here. Is there any closing comment you want to make before I put up the contact information if people have additional questions for you?
No, I think the most important thing is what we need to do, especially when we're thinking about investing and where we should put our money and get it to work, is to remember that the pressure of money is one of the greatest forces right now in driving up asset values, and things don't go in a straight line. You will have pullbacks, you will have drops in value, but if your time horizon is of a decent length, 5 years, 10 years, you should basically be invested, stay invested, and look for opportunities where you could potentially maybe, switch out of certain sectors, move into other sectors. Some of the best ways to invest are through mutual funds, because you've got professional money managers managing and making decisions on what stocks to put in, what stocks to rotate out of, which stocks to sell, which ones to add, buy, all that kind of stuff. So there's some really good funds out there where the performance has been great, even through difficult times like these. And then there are some great stocks that, great companies that got beaten up pretty badly, that you can go and buy that pay dividends and get a return that way. So thing is not to be scared of it. It's a part of life. It's kind of like your health. Today you're in great health. Tomorrow you got some sniffles, your temperature rises, falls, the blood pressure goes up, it goes down. Nobody gets a daily report on what the status of their health is. Their cholesterol levels change, but people don't get freaked out by that stuff because they don't know. Nobody gives them a report daily on where things stand. Your investments are the only thing that you get a minute by minute update on where things stand. And that's the reason why people kind of let themselves go crazy with where things are, and the media picks up on all of that, and they kind of add fuel to the fire. The best thing you can do is keep a level head, understand how these things work. Nothing goes in a straight line, but the trend has been, since the beginning of the stock market, from the bottom left to the upper right.
Very good. Thank you, Mike. I hope everyone can see the slide that I put up. And if you can, I'm sorry, but I will read out the contact information. If you have more questions that you want to talk to Michael or maybe one of his team members directly, you can call 416-763-5575, extension 153, or email him at mzienchuk, that's MZIENCHUK at ukrainiancu.com. And if you have any general feedback about the webinar or other topics you want to listen, hear about, have either Michael or someone else speak about, please email me at marketing@ukrainiancu.com. Also, please don't forget to sign up if you're interested for our upcoming Class A share seminar, Monday at 12 p.m. Michael will be presenting that as well. So I want to thank everyone for coming. Hopefully you got some good value out of this, and we will see you again shortly. Thank you very much.